What if the toughest real estate market in over 100 years is already behind us and most people have no idea they just lived through it? I am Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. You're listening to Ron Siegel Radio, and today we're doing something a little different. We're going to talk about where the real estate market has been, where the data says it's going, and what that means for you right now. Let's start with some context because I think it matters. I recently came across some research from one of the most respected voices in real estate coaching, someone with a 40-year track record and a 92% accuracy rate on market predictions. And his assessment of the last few years was sobering. He called it the hardest real estate market in 107 years, not 2008, not the savings and loan crisis of the late 80s, the period we just came through. Sales volumes dropped to levels not seen since 1995, and there are 80 million more people living in this country today than there were then. Think about what that means in terms of demand that simply wasn't being served. But here's why most people missed it. Consumers weren't hurt the way they were in 2008. There were no widespread foreclosures, no dramatic headlines. The damage was absorbed inside the real estate and mortgage industry, not on the evening news. So the general public largely moved. They moved on while the professionals navigating those markets quietly endured one of the most difficult stretches in modern history. That context matters because we are now on the other side of it. But before we talk about where the market is going, we need to spend a moment on where it came from, because I think there is a fundamental misunderstanding in the minds of a lot of buyers, sellers, and homeowners. And that misunderstanding is costing people. The 2020 to 2022 real estate market was not normal. It was not a high point. It was not something the market earned. It was artificial, entirely constructed by a set of circumstances that had never existed before in the modern era and are very unlikely to exist again. Here's what actually happened. When the pandemic hit, the federal government responded with an unprecedented wave of financial intervention. Stimulus went out to households across the country. PPP loans flooded small businesses with cash, and the Federal Reserve, in an effort to keep the economy from collapsing, dropped interest rates to near zero. Essentially, free money. What do you think happens to real estate when the cost of borrowing drops to almost nothing and households are suddenly sitting on cash they weren't expecting? Demand exploded, and supply, already constrained, couldn't come close to keeping up. So prices shot up. Bidding wars broke out on nearly every listing. Buyers were waiving inspections, waiving appraisals, writing personal letters to sellers, offering tens of thousands over asking just to be considered. In some markets, homes were under contract within hours of hitting the market. And people started to believe that was just how real estate worked now. It wasn't. It was a mirage, a temporary condition built entirely on intervention that was always going to end. Yes, it was always going to end. And when the Federal Reserve began raising rates to combat the inflation that all of that stimulus created, the mirage evaporated almost overnight. Rates went from the low threes to the sevens in a matter of months. The buyers who had been racing to purchase at any price suddenly couldn't qualify for what they were offering. Transaction volume collapsed. The industry went from the most frenetic market in a generation to one of the slowest on record, almost instantly. That is not how healthy markets behave. Healthy markets don't do that. Artificial ones do. And this is the part that I think is really important for anyone making a real estate or financial decision today. If your reference point for what the market should look like is 2021, you are collaborating to an illusion. You're calibrating to an illusion. Sellers who are pricing based on 2021 comparable sales are overpricing. Buyers who are waiting for 2021 rates to return are waiting for policy experiment that the Federal Reserve has made very clear it has no intention of repeating. And homeowners who feel like they missed something are measuring themselves against a benchmark that was never real. The real benchmark is the pre-pandemic market, and by that measure, things are actually in pretty good shape. Inventory levels are normalizing. Days on market are returning to pre-pandemic ranges, and sales volume is projected to increase by approximately 14% in 2026. That's not a small number. That represents a meaningful shift in market activity and is already showing up in the data. From a rate perspective, the forecast for 2026 points toward modest improvement, not a dramatic drop, but a gradual easing that should bring more buyers off the sidelines and continue the recovery in transaction volume. The Federal Reserve has signaled a careful data-dependent approach to any further rate adjustments, which means the market is likely to see steady, measured progress rather than the kind of dramatic swings we experienced during the pandemic years. Now, one aspect of today's market that often surprises people, roughly 30% of real estate transactions right now are all cash purchases, no mortgage involved. That tells you something important about who is active in this market. These are established households, equity-rich sellers rolling proceeds into the next home, investors and multi-generational families pooling resources. Understanding who is actually transacting today is critical to understanding where the real opportunities are. Multi-generational buying is one of the fastest growing segments in real estate right now. Families buying together, combining incomes and resources to purchase a home that works for multiple generations. The demographic data supports continued growth in this segment, driven by affordability pressure, aging parents, and shifting attitudes around family living arrangements. On the first-time buyer side, the path is longer than it was a few years ago, but it is not closed. The buyers who are preparing now, working on their credit, building savings, understanding their complete financial picture, those are the buyers who will be positioned to move when the window opens for them. And that stability is good news. A market that moves in a predictable direction, even a measured one, gives buyers, sellers, and families making long-term financial decisions something they can actually work with. Volatile markets built on intervention are impossible to plan around. This one you can plan around. The bottom line from everything the data is pointing to right now, 2026 is shaping up to be a year of real, measurable recovery. Not a return to the artificial highs of 2021, but a return to a market that functions the way a real healthy real estate environment is supposed to function. One where preparation, strategy, and a clear understanding of your financial position determines outcomes far more than luck or timing. And that is exactly the kind of market where strategy beats rate. Always. If you want to understand where you stand in this market, whether you're thinking about buying, selling, or just want to get your financial house in order before the opportunity presents itself, go to rsrlinks.com/keysteps. That's rsrlinks.com/keysteps. It's a starting point to help you understand what you have, what you need, and what the right next move looks like for your situation. The market has been through something significant. The data says the recovery is real, and the families who come out ahead will be the ones who took the time to understand their position and made decisions based on strategy, not emotion, and not the hope that yesterday's market is coming back. I am Ron Siegel, your certified liability advisor, helping families build wealth through strategic debt management. Thanks for listening to the Real-Time Real Estate segment brought to you by rsrmoney.com, rsrmoney.com.